118 token launches hit the market in 2025. Memento Research tracked every single one. 85% lost money. The median investor did not lose a little. The median investor lost 71%. Here is what nobody is telling you about those numbers. They were just the setup. Because in 2026, the format that created those losses did not slow down. It essentially stopped. CoinRank counted 6 completed ICOs through mid-May. 6. CoinList alone ran 21 in all of 2025. The mechanism that gave retail investors early access to crypto projects, the same mechanism that turned early believers into millionaires in 2017, is gone. And when you understand why it's gone, you will understand something important about who benefits from the fact that it's gone. Today, we're going to cover 2 things. First, who actually killed the ICO and why the obituary they're writing blames the wrong suspect. Second, who pays for it? Not just retail investors, though they pay plenty. The crypto startups that needed the funding to get built in the first place. The projects you will never see because the only path left runs through the same venture capital firm's My Book documents. Once you see the mechanism, you cannot unsee it. If this kind of forensic analysis is useful to you, subscribe. I publish this so you have the information that the people who benefit from your confusion would prefer you not have. Let me tell you what the story is not about. It is not about the crypto market being down. Markets go down. That is not news, and it is not the mechanism. It is not about regulation killing ICOs. You are going to hear that argument. It is the wrong answer, and I will show you why. And it is not about retail investors being too dumb to evaluate token launches. That framing exists to protect the people who designed the launch structure. It is not an explanation. It is a deflection. Here is what this story is actually about. In 2017, a retail investor with $200 and an internet connection could buy into Ethereum, Filecoin, Tezos, or a dozen other projects at the same price insiders paid. Not a similar price, the same price. ICOs in that era were genuinely democratic. They were rough, they were unregulated, many of them failed, but the entry was equal. What replaced that model was designed to look the same while working completely differently. The names changed, the allocation structure did not. By the time you could buy, the insiders had already been positioned. The token generation event was not your entry point. For most projects in 2025, the data shows it was the top. Now, not even that structure is gone. Not reformed, gone. 6 ICOs through mid-May 2026, and the crypto startups that would have used that mechanism to get funded are either taking VC money on VC terms, or they're not getting built. That is the mechanism. Let's walk through it. The official story goes like this. ICOs got too dangerous, too many scams, too much retail money lost. The market evolved toward better structures, IDOs, IEOs, airdrops, and that evolution protected investors. I want to examine that story carefully because it contains a true fact wrapped around a false conclusion. The true fact. A lot of retail money was lost in ICOs. The losses in 2025 were real. Your losses were real. The false conclusion. The structures that replaced ICOs protect you better. They do not. They protect the people who were already inside. Before I walk you through the mechanism, I want to name what actually happened in 2025, because there is a word for what the data describes, and the industry does not like it being applied here. In crypto, a rug pull is when insiders sell off their holdings and drain the liquidity, leaving retail holding worthless tokens. It is understood as a scam. It is what small operators get prosecuted for. Here is what Memento Research found across 118 tracked launches in 2025. 85% of tokens are below their launch price. The median retail loss is 71%. The FDV weighted return, meaning weighted by the size of the launch, is negative 61%. The bigger the project, the worse the outcome for public buyers. Of the 28 launches that started with a fully diluted valuation above $1 billion, not one is in the green. Not one. The insiders in those projects were not anonymous developers who disappeared overnight. They were venture capital firms. They received token allocations at seed pricing, a fraction of the public launch price. They waited for their vesting cliffs, if they had them at all, and sold into retail demand. The liquidity did not drain in one transaction. It drained across thousands of transactions over weeks and sometimes months. The retail investor who bought Berachain at a $4.5 billion valuation and watched it fall to $378 million did not experience a different outcome because the exit took 6 weeks instead of 6 hours. They lost 93% either way. In traditional crypto vocabulary, a rug pull is what happens when small operators do it. In 2025, the same exit pattern ran at an institutional scale across more than 100 tracked launches, executed by venture-backed firms with legal teams and compliance departments. The mechanism was identical. The information asymmetry was identical. Insiders knew the unlock schedule. Retail did not understand its implications. The reason one version is called a scam and the other is called a market cycle is that the people executing the institutional version control the vocabulary. That is what retail is exhausted from. Not volatility, not risk. The systemic transfer of wealth from people who bought at public prices to people who bought at seed prices, dressed up as innovation and early access. Now, let me show you how the replacement structures made it worse. An ICO in its original form is a direct sale. The project sets a price. You send money, you get tokens at that price. The same price the seed investors paid, or close to it. No intermediary taking a cut of your allocation, no platform deciding how much you're allowed to buy. The transaction is between you and the project. In 2017, tokens purchased in ICOs returned an average of 12.8 times the initial investment across more than 400 launches. That is not every investor getting rich. Many lost money even then. There was fraud even then. But the average is real because the structure allowed retail to participate at prices where genuine upside existed. When entry is equal, the upside can be equal. Now, look at what replaced that structure and watch who benefits at each step. The IEO, the initial exchange offering. The exchange vets the project, manages the sale, and decides who participates. You need an account on that exchange. The exchange takes a significant fee from the project, which gets built into the token price. And crucially, the exchange itself often receives a token allocation at pre-sale pricing before the public sale opens. You are not buying at the same price as the house. You are buying after the house has already positioned. Now, here is a question we did not fully answer in our recent video on wash trading, and it connects directly to IEOs. We showed you that over 70% of reported volume on unregulated crypto exchanges is fabricated. Chainalysis identified $2.57 billion in suspected wash trading on decentralized exchanges alone in 2025. Academic research found that some exchanges exaggerate their actual trading volume by a factor of 25 to 50 times. The question we left open: why? And which tokens is the fake volume actually propping up? Exchanges compete for listings. Projects choose which exchange to launch on based on reported volume, because more apparent volume means more apparent liquidity, which makes a token launch look viable to retail buyers. If your exchange reports $500 million a day in volume, you get the listing. If your exchange has 42 million in real volume, you do not. So you manufacture the rest. And the fake volume is not propping up Bitcoin. Bitcoin and Ethereum trade on regulated exchanges. Coinbase is registered with the SEC. Fidelity Digital Assets operates under banking supervision. Those institutions do not run token launch pads. They do not host IEOs. They list established assets with genuine price discovery. The exchanges running IEOs, Binance, Launchpad, OKX Jumpstart, KuCoin Spotlight, they're the same exchanges where the academic research and the chain analysis data find the highest concentrations of wash trading. The manufactured liquidity exists specifically to make newly launched tokens look viable during the precise window when retail is being invited to buy in. So, the exchange gets the listing fee, the exchange gets its own token allocation at pre-sale pricing, the exchange gets the trading fees when retail buys and sells, the exchange manufactures the volume that makes the token look active, and the retail investor, looking at apparently robust trading activity, reads that as a legitimate demand signal. It is not legitimate demand. It is the theater of legitimate demand operated by the same platform that sold you early access and took a cut of every transaction. Now, the IDO, the initial DEX offering. This one sounds more democratic because it runs on a decentralized exchange, but the launchpad hosting the IDO requires you to hold and stake a specific token to get whitelist access. The more you stake, the better your allocation tier. The people already in crypto with capital already deployed get best access. The retail investor who is new or who does not know that specific launchpad ecosystem, they buy after listing, after the whitelist participants have already received tokens at their lower prices. And then there's the airdrops. You farm activity on a protocol for months. You click, transact, complete tasks. At the end, the project converts all your points to tokens and distributes them. This sounds generous. Here's what is actually happening. The project raised venture capital before the airdrop. The VCs got tokens at seed pricing locked for a year or 18 months. The airdrop creates the initial market liquidity the VCs need to eventually exit into. You are not getting early access. You're building their exit ramp. Every replacement structure follows the same logic. The entry that used to be equal is now tiered. The tiers favor the people who are already inside. Retail arrives last at prices that already reflect the profit the people ahead of them plan to take. The projects that performed best in 2025 had one thing in common: low launch FDVs that left room for organic price discovery. The projects that performed worse, they launched with high FDVs set to maximize inside or exit value. Memento Research said it plainly. The token generation event in 2025 signaled the top for most projects, not the entry. That pattern is not a market anomaly. It is the market functioning as designed. So, who killed the ICO? I'm sorry. It wasn't the SEC, it wasn't regulators. The Trump administration's crypto posture is the most favorable the industry has ever seen, and the ICO is still essentially dead. Retail killed the ICO by running out of money and trust. Retail got burned systematically. Retail stopped showing up. When retail stopped showing up, there was no exit ramp for the insiders who needed to sell their allocations. When there was no exit ramp, the format stopped generating returns for the people who run it. So, they moved the playbook. 40 cents of every crypto VC dollar in 2025 went to AI-focused firms, more than double the year before. The same people who built the ICO market did not leave, they just changed the sign on the door. That is the answer to who killed the ICO. The ICO was killed by the people who needed retail to stop arriving at the same price they did. Once retail figured out it was the exit, not the entry, the game was over. And the people running the game had already found a new room. I want to pause here because I know what some of you are thinking. You're thinking, if retail kept getting burned in ICOs, maybe it was better that ICOs stopped. Maybe retail is safer now. That is a reasonable instinct, and I want to take it seriously because the answer is not simple. Retail is not safer now. Retail has not exited a risky market. Retail is still buying crypto assets. The difference is that retail is now buying after the early price discovery has already happened, after insiders have already positioned, at prices that reflect the extraction that already occurred rather than the potential that has not yet been priced in. The choice is not between ICO risk and no risk. The choice is between early access with honest pricing and late access with pricing that already reflects insider profit taking. The ICO at its best offered the first option. What replaced it offers only the second. And the effect is not on retail investors alone. There are two victims in the story. Retail investors are the visible one. The less visible victim is the crypto startup that needed the ICO model to exist. Let me explain what I mean. The ICO was not just a distribution mechanism for tokens. It was a funding mechanism for projects that could not access traditional venture capital, either because they were too early, too unconventional, not in the right zip code, or too committed to a structure that genuine VC terms would have destroyed. When a project does an ICO, it raises money from the people who will use the product. Those people have a direct incentive for the project to succeed. They're not passive capital looking for a return on a 3-year timeline. They're the users with tokens, which means they're ambassadors, testers, and critics with skin in the game. That alignment between early capital and early users is genuinely valuable, and it does not exist in any of the replacement structures. When a project takes VC money, the alignment runs in a different direction. The VC needs a return on their fund's timeline, which is typically 3 to 5 years. The VC got in at seed pricing, which means their return targets are built around a token price that is many, many multiples of what they paid. The VC's exit requires retail buyers to absorb their position at a price that already reflects the VC's profit. That is not alignment between capital and users. That is the extraction model. Now, look at what has happened to early stage crypto funding in 2026. The crypto VC market has not replaced the ICO with an equivalent funding flow to early stage projects. It has contracted and concentrated at the same time. Deal count fell nearly 50% in Q1 2026 versus the first quarter of last year. But the average deal size increased 76%. The money that is still moving is moving into larger, later stage companies. There's Galaxy Digital research that confirms it directly. 57% of capital went to later stage companies in 2025, the highest share on record, and that trend has continued into 2026. Early stage projects, the ones that are not already proven, the ones that need community funding to get off the ground, they're not getting any money. The projects that would have raised $2 million from 10,000 retail believers in 2017 or 2021 have no equivalent mechanism today. They either convince a VC to write a check on VC terms, or they don't get built. And if they do convince a VC to write that check, they enter the extraction model from day one. The VC's terms dictate the token allocation structure. The VC's timeline dictates when the token launches. The VC's return requirements dictate the FDV at which the token launches, which we have already established is set too high, which we already know predicts poor retail outcomes. The pipeline of crypto projects that would have competed with VC-backed tokens, the ones that might have been built with community money and user alignment, is drying up. The projects that do not get funded are increasingly built to serve the exit needs of their investors, not the utility needs of their users. Memento Research found that the infrastructure and AI categories, which together represent 60% of 2025 token launches, were among the worst performers. They were also the categories that attracted the most VC attention. That correlation is not a coincidence. Projects built for VC exit underperform projects built for user utility. The data says so plainly. Let me give you the clearest version of where this ends. If ICOs remain at 6 for the year, which is where the trajectory points, the retail investor has no legitimate path to early participation in new crypto projects. Full stop. That's it. The only options available are buying tokens after insiders have already positioned, providing exit liquidity for VC allocations under a different name, or not participating at all. And the crypto startup that would have built the next generation of genuinely useful community-funded protocols, they can't access the capital that would have built it. The VC firms that would fund it instead want infrastructure plays with high FDVs that generate quick returns because that's what their fund structures require. The result is a crypto market that looks active on the surface. Bitcoin still trades, Ethereum still trades, the price charts are still moving, but the innovation pipeline that depends on early-stage community funding is closing. The ICO's death is not just a story about retail investors losing access. It is a story about who gets to decide which crypto projects exist. Right now, that answer is venture capital. The same venture capital firms buy book documents. The same extraction model applied to the funding stage rather than the distribution stage. The narrative that will be offered to you is that the ICO died because it was dangerous, because retail was losing money, because better structures emerged to protect investors. I want you to hold that narrative against the data. Better structures for whom? Retail outcomes in 2025 under the replacement structures, median loss of 71%. Retail access to early pricing in 2026 under the replacement structures, 6 ICOs through mid-May. VC deal concentration at later stage companies in 2025 and 2026, the highest on record. AI receiving 40 cents of every crypto VC dollar in 2025, more than double the prior year. Confirmed. The ICO is not dead because it failed retail investors. It is dead because it occasionally succeeded to give retail investors a seat at the same table as insiders. The people who benefit from retail sitting at a different table, one where the pricing is already moved, but built the structures that ensured that outcome. And they wrote the obituary that blamed the patient. If you want to understand this mechanism in full, it's documented in the Token Trap. There's a link in the description. I have 617 sources, 23 victims interviews, and $847,000 in documented losses across them. The thesis is not that complicated. Crypto was captured. The same playbook is now running in AI. The ICO's death is one chapter in a much longer story. Like and subscribe if you want more of this kind of insider analysis. I hope it's helpful. And if you've been following along for a while and you've stuck through this video to the end, thank you. Share this with someone who's still trying to figure out why every token they buy seems to be at the top. I'm Dana Love. I'll see you in the next one.